We're in an environment right now where corporate earnings are flat or even falling. Revenue growth is slowing. There's concerns about global growth, and you have relatively high valuations in this market. What's the case that you're making here that stocks actually have a little bit more room to run?
Well, first of all, no recession, no trade war, and very importantly, very low interest rates. The Fed is going to cut. I believe only 25 basis points. And by the way, I think the guidance might disappoint the street a little bit. I'm not sure that they're going to say we're cutting again in September or going to move in that direction. So, there might be a little bit of a blip there for equities. But basically, with a long bond around 2%, no competition. The dividend yield on S&P is almost 2%, so I don't see anyone really running away from equities at this point.
Certainly when you've got 13 trillion or however many negative yielding bonds out there, it seems to be an asset of choice. I'm interested in what parts of the overall S&P or indeed benchmarks you think can drive us higher, because thus far this year it's been tech, it's been consumer discretionary, it's been communication services. Will they still lead the way higher, Jeremy?
Well, they could. I don't do a lot of individual sector analysis. I do know what is important is the dollar. If the dollar goes down, then those internationally based companies could do very well in terms of the translation, because they're having a tough time with the dollar being so high. So I think if I think about threats, I would say that those that have a big international exposure, and if the dollar continues to go higher, that would be a threat to earnings. And everyone's right. I mean, earnings are low single-digit increases this year. So what's supporting the market is basically really low interest rates.